Today I'd like to review the debt to income ratio, which is something that mortgage lenders look at when you apply for a mortgage for a home. So let's get right into it. On this side, we have our income. We have all our income for the year um, listed here, our salary. Now, this is our gross income, not our net, our gross income, which is what we make minus tax is what you take home is your net. So this is gross number. Okay, this is the gross salary for the year, annual. So any part-time jobs that you had over the year would go in here, and any other income that you came into that's reportable for this will go in there. Okay, so your income for the year would be $61,750. So over here, we're going to list the debts and the sources of the debt. So we've got a mortgage. There's a zero there because this person doesn't have a mortgage yet. We have a car loan that's $12,000. That's how much they owe on it. No credit cards, which is excellent. And a student loan with a $5,000 balance. So we have $17,000 on this side for debts. So if you go to this formula, you're going to take this number, the debt, and you're going to divide it by this number, which is the income, and you're going to get 27.53% for this particular scenario, which is excellent. So let's fudge these numbers up a little bit. We're going to keep this the same as 61,750, and we're just going to put credit card payments in there. Now that's a total that you owe for your credit cards. I'm going to put something like $26,000. Oops, 26,000 in here. Okay. No mortgage. Oh my goodness. Okay. So now we've got $43,000 worth of debt. Look how much has changed your debt to income ratio. 69%. I don't know any lender that will lend you money with a 69% debt to income ratio. So before you apply for a mortgage, you got to get this paid off or down. Get rid of this too. Get rid of all these. Just think, let's see something. Watch this. We don't have any debt. Look at our debt to income ratio. Oh my goodness. I wonder what that means. That means you have no debt and you have an income. So this income is good to go. There's no debt over here. There's no debt to income ratio because you have no debt. So let's try another scenario. Let's try 20,000 in credit cards, and that's it. Now we're at 32% debt to income ratio. So let's look over on this other page and see what 26 and 32% mean. I'm going to go through some terms here. We have a conventional mortgage, which is right here. Their debt to income ratio is usually 43 to 50%. Has to be in there or below. Okay, some lenders it could be 49%, some might be 44%. So this is based on the bank or the credit union standards for mortgage lending. So they each have their own debt to income ratio number, but it's usually in between this number. So a conventional mortgage is traditional mortgages not issued or insured, or guaranteed by the government, offered by private lenders. So let's go to the FHA loan. Loans secured by the Federal Housing Administration designed to help low to moderate income borrowers. Their debt to income ratio is 50%. Now, or below, okay? But that's the max, 50%. So VA is for veterans and their families, and that's offered by the U.S. Department of Veterans Affairs, and they have a slightly higher debt to income ratio, 41 to 61%. So USDA, loans guaranteed by the U.S. Department of Agriculture for properties in eligible rural areas, aimed at low to moderate income borrowers. So that debt to income ratio for those type loans is 41 to 45%. So that gives you an idea of where you sit. These are the numbers, the high numbers. Anything below this is great. Anything above this, you're out. You got to get your debt down. So let's just go down here a minute. So the debt to income ratio, excellent. Debt to income ratio is very little debt compared to income. This is very favorable for a mortgage if you are in here. If you're 21 to 30%, it's good. Debt is under control, considered safe and healthy. 31 to 36% is acceptable, but now you're getting a little tighter. You know, you're getting up to the number that they're not wanting, but you're still within range. You're still good. And then 44%, usually very risky, too much debt. Most lenders will deny loans. Up here, it does say 43 to 50, but you know, this is getting risky right here. Plus, you don't want to get a home and be house poor where you can't afford to do anything except pay on your mortgage. So I hope this explained a couple things about the debt to income ratio. Please see my other videos and like them, and come back and view some more videos. Subscribe and like, and thanks for visiting. I appreciate it. Thank you. Bye-bye.